Hi there folks, now today is a very important lesson, so maybe you want to take notes. Today I want to talk to you about how you can evaluate your trading strategy and your trading performance. Now before I get into the nuts and bolts about that, let me talk briefly about what a strategy is for those that don't know. A trading strategy is basically a set of rules that you follow when making your trading decisions. So if this does this, I will do that. Then if the market does this, I will do that to take my profits or cut a loss or what have you. Now, strategy shouldn't be kept up there. It should be written down and followed meticulously. Now, you'll be amazed by the number of rookie traders that I see coming to the markets that don't have a defined strategy. And I say the term quite loosely when I say traders, more like gamblers, in my opinion. Now, a trading strategy, remember this, doesn't have to be complicated. In fact, I would go as far as to say that the more simple the strategy is, the more likely it is to succeed. Now, of course, you can develop your own strategy. You can use someone else's or whatever. You can use one of ours. We've got plenty of strategies that we teach inside our trading room. But in order for you to set yourself aside from the 95% of those losers out there, you need to make the strategy your own. And when I say make it your own, I don't mean reinvent the wheel. I don't mean put in a Bollinger Band or an RSI. No, there are some great strategies out there that you can use out of the box. But you need to take ownership of the strategy. You need to make it your own. You need to know everything about the strategy and ultimately take responsibility for it. No one cares about your money more than you. So, how do you do that? Well, of course, what you need to do, you need to backtest. You need to backtest the living daylights out of it. That basically means you need to run it over past data to see the characteristics of the strategy, how it performs over time. Now, I'm not going to go into the backtesting process now. That is a separate lesson, a very important one. We cover that on itself. Today, I want to talk about what you should be looking for when you're evaluating your strategy. Now, the common misconception when you see a strategy deciding whether to trade it or not is to look at the profit and loss. Did it return a profit over time, and then deciding whether it's worth trading. But that is the wrong way to evaluate a strategy. Remember, you need to know the strategy inside out, how it actually performs. And the way we do that is by looking at certain metrics. Now, these metrics are important not only in the backtesting phase, but also in the real life trading as well. You look back at the backtesting results, the historical data, and look at your current trading performance and see if it's in tune with your backtesting results to know if the strategy is broken and therefore no longer conforming to the expectations. Remember my most important video lesson I've ever put out there? The cycle of doom. It's the biggest #1 reason why traders fail in this business. Now, if you understand these metrics, if you understand how to use them, you're going to be halfway there to the challenge of not falling into that cycle of doom. So come on, let's have a look at these important metrics and how we apply them. Okay, so trading metrics. How good is your trading strategy? Before we get into the finer detail, I want to talk to you first off about the trade journal. It's very important that you journal all your results, all your backtesting results, all your demo trading results, indeed, even your live trading results as well. Putting all this into one central place enables you to basically work out and monitor these metrics, so you can make sure that your current trading is in line with your backtesting results. Here's an example of a trade journal. Okay, so this is a basic trade journal done on Excel. You can buy these, you can find these elsewhere. I'm not going to go into too much about that at the moment, but of course it's got everything you need to know about the trade. So you've got the buy, the entry price, the size of the trade, the stop loss, the take profit target 1, take profit target 2. You also put comments in there as well. Now, you can do this on a good old-fashioned pen and paper. I prefer to do it on Excel because then you can filter out certain parts of the year, you can filter out certain currencies to get a better picture. But it's really important that you keep a journal so that basically you can get all this information that you need to work out these metrics. And if you know anything about Excel, you can put them into a nice fancy little calculator as well that does all the calculations for you. So that's just a basic journal, but make sure you keep a journal. It's so important going forward. Okay, so now let's look then at these key metrics from the data that you're going to get out of your trading journal. You can see why the trading journal is going to be so important. Okay, first off, we'll look at the win rate and the loss rate. Simply put, the win rate is the number of winning trades divided by the number of total trades that you've taken. And of course, the other side of that will be the loss rate. So the loss rate will be the number of losses divided by the number of losing trades. But be careful of this number. This number is the number that you often see brandished out there by the educators and the vendors and the gurus out there trying to sell you strategies and trading courses. They will tell you they've got a 95% win rate. Well, you've often heard that expression in the past. If it's too good to be true, well, I'll let you complete the rest of that sentence. Don't just look at the win rate as a standalone piece of data, because it doesn't give you the full picture of the strategy. You need to look at it in conjunction with other data. For example, the average win and the average loss. Simply put, the average win will be the total dollars of all the winning trades, put them all together, divide that by the number of winning trades. That will give you the average size of a winning trade. And of course, the other side, the average loss will be the total dollars lost on all the losing trades divided by the number of losses. So you can see why these have to be looked together in conjunction with each other. Here's an example. Let's assume we've got a strategy that's been peddled out there with a 95% win rate. That means for every 100 trades, you're going to have 95 winning trades and you're going to have 5 losing trades. Okay, so it's going to have a 95% win rate. That will be a 5% loss rate. Let's assume that for every winning trade, we're going to make, say, $10. Okay, after the 100 trades, you're going to end up with $950. Now let's assume on the losing side, the 5% losers, every time you have a losing trade, the losses are bigger. Say they are, say, $200. Well, 5 times 200 is going to be 1,000. Yeah. Here you've got a loss of 1,000, profit of 950. You've got a loss of $50. This is a losing strategy. You will lose money trading a strategy with a 95% win rate if the other metrics, the average win, average losses, don't work for you. So be very careful when you see these strategies advertised out there with a very high percentage win rate. Okay, next up we've got the profit factor. Very important number, this, when evaluating a strategy, certainly if you're looking about buying a strategy from someone else. So the profit factor is basically the total dollars profit from all the profitable trades divided by the total dollars lost on all the losing trades. So for example, if all the profits that you had added up to $1,500 and all the losses you had came up to $1,000, 1,500 divided by 1,000 would give you a profit factor of 1.5. Now clearly, when you're trading a strategy, you need to have a positive profit factor. Certainly when I'm evaluating strategies, because of the back testing, in irregularities sometimes, I always like to have a profit factor at least 1.5, more in tune with something around 2.0 or above. But the profit factor is very important because it basically tells you, is the strategy going to be profitable or not over time? So you need to know your profit factor, and you also need to know your profit factor, how it deviates as well, how it deviates, because it's not always going to be 1.5. It will rotate, it will oscillate from 1.8 down to 1.3 maybe. So you need to know the characteristics of the profit factor to make sure that your strategy isn't indeed broken. Next up, we want to look at the expectancy. Expectancy is mostly one of the biggest numbers that we look at as a trader. Let me explain exactly what the expectancy is. It's the win rate as a percentage times the average win, average size of the winning trade, and from there you subtract the loss rate as a percentage, which is multiplied by the average loss. Okay, so let's assume now that I've got a strategy with a 40% win rate. Okay, so that basically means for every 100 trades, I'm going to make money on 40 of them. The win rate is 40%, then clearly the loss rate is going to be 60%. Okay, let's assume now that the winners, the average size of the winners is going to be $250 on all my winning trades. That's the average size of the winning trades. If I multiply 40% of 250, it's going to give me $100. Okay, 0.4 times 250 is going to be $100. Now let's look at the losses. If the size of my losses is going to be smaller, say for example $100, if I multiply 60%, 0.6 of 100 is going to give me $60. Now, if I subtract $60, the losers, from the $100 on the winners, is going to give me $40. Funny old dollar sign that. $40. So my expectancy on this strategy is 40. That basically means for every trade that I take, I can expect to make $40 per trade. Now, of course, I'm not going to make $40 on every trade. This is what I expect to make over a large sample of trades. So if I'm taking 100 trades or 500 trades into the future, I can expect to receive $40 on average after those trades. Again, don't think of it just as of the next trade, because it plays out over time. That's what you can expect. It's a very important number. So when evaluating your strategy, always look at the expectancy and also look at the deviations of the strategy. Is it changing? Is it increasing or decreasing from what you expect or what you've seen in your back testing? Keeping an eye on your expectancy is very, very important. Okay, next up we have the drawdown. Very important number when evaluating a strategy. It's basically defined as the percentage fall from an equity high to a new equity low. As traders, we're always looking at the state of our account. Is it growing or is it depreciating in value? In an ideal world, our equity growth will be something like that, always growing with no drawdowns. But in reality, life isn't like that. We all have losing trades, we all have losing periods as well. So an equity curve may look indeed something like this. Okay, you're making some nice money, then you give some back, and then okay, so off you go again, make some more money, make a new equity high, so we're now making more money. But then of course the inevitable happens, we have our losing periods as well. So this period here is basically known as the drawdown period. Okay, this period here is the drawdown, the percentage drop in value of the trading account, and off it goes again. So for example, if up here we had an equity high of say $10,000, we've got $10,000 in the trading account, then we have this drawdown period and we take it down to $8,000. Okay, so that basically would be a 20% drawdown on that account. So you need to know the drawdown. You need to know what it's likely to give. Are you able to stomach a high drawdown? You may see a strategy that might return 100% in a year. But if it's got a 75% drawdown, are you able to stomach that? Are you able to continue with that strategy? So you need to know the maximum drawdown that your trading strategy could deliver going forward. Very important number when evaluating your strategy. So keep an eye on that one. And lastly, I want to talk about consecutive wins and consecutive losses. Very important piece of data, often gets overlooked, but it's very powerful when defining your strategy, if it's still working, or indeed if it's broken and it needs maybe throwing out or adjusting. Basically does what it says on the tin. If you're having winning trades and everything's looking good and you have 3 winning trades there, then you have some losing trades, you have 5 losing trades there, and you have a winning trade and there's a couple of losers as well, then you get some winning trades as you go. It's important to know the consecutive losses to make sure the strategy isn't broken. It's also very good for your confidence level. It's very hard to continue trading a strategy when you're having 5, 6, 7 losers on the bounce. However, if you've done your back testing and you know how the strategy performs, you know in back testing it's had up to 12 losing trades at one point, but it's still a profitable month or quarter or what have you, then it gives you the confidence to trade continuation with that strategy. You don't want to be throwing out a strategy just because it's having a few losing trades. So you need to know how the strategy has performed in the past in terms of consecutive wins and consecutive losses, so you know what's happening in the future, gives you the confidence to carry on. So make sure you take a note of those metrics. Make sure you incorporate them now in your strategy evaluation and indeed your trading evaluation going forward. Okay, so I hope you liked the video. If you did, give me a thumbs up. If you didn't, give me a thumbs down. Don't forget to subscribe to the channel now if you don't already do so. Hit that notification. You'll be notified the moment my next video has been released, which is now going to be every Monday, where I release a market commentary for the week ahead, telling you basically what we are looking at. Don't forget to follow us on all the socials, and of course, if you follow us on Facebook, you can tune in live 2 p.m. London time for a live event where we discuss trading opportunities for the week ahead. I'll see you next week. Have a good one.